Before we dive into the how, let's touch upon the why. Accurately recording loans in FreshBooks offers several key benefits. Clear financial picture. By logging your loan, you gain a complete understanding of your business's assets and liabilities. This provides a more accurate snapshot of your financial standing. Tracking repayments. FreshBooks helps you keep track of your loan payments, ensuring you don't miss any due dates and potentially incur late fees. Interest expense management. Recording the interest portion of your loan payments allows you to accurately track this business expense, which is often tax deductible. Accurate reporting. When it comes time for financial reporting or tax preparation, having your loan details accurately recorded in FreshBooks simplifies the process and reduces the risk of errors. Better decision-making. A clear understanding of your debt obligations empowers you to make informed financial decisions for your business. Step-by-step guide to recording your loan in FreshBooks. FreshBooks doesn't have a dedicated loans section like some more complex accounting software. However, we can effectively record your loan using the existing features, primarily by creating a new expense and then tracking the repayments. Here's how. Phase 1. Setting up the initial loan amount. Navigate to the Expenses section. On your FreshBooks dashboard, locate the Expenses tab on the left-hand sidebar and click on it. Create a new expense. Click the green plus New Expense button in the top right corner of the Expenses page. Fill in the details. This is where we'll input the initial loan information. Vendor. Enter the name of the lender, e.g., First National Bank, online lending platform. You can also add them as a new vendor if they don't already exist in your list. Date. Enter the date you received the loan funds. Category. This is a crucial step. Since FreshBooks doesn't have a specific loan received category, we'll use a liability account. If you haven't already created one, you'll need to do so. To create a new category, click the drop-down arrow, then plus New Category. Name it something clear like Loan Payable, Notes Payable, or Lender Name Loan. Ensure the type is set to Liability. Click Save. Now, select this newly created liability category. Amount. Enter the total principal amount of the loan you received. Tax. If applicable generally, loan proceeds are not subject to sales tax, so you can usually leave this at no tax. Description. Optional but recommended. Add a brief description, such as initial principal amount of business loan or loan agreement #XYZ. This helps provide context for the transaction. Billable. Optional unless you are specifically passing on the loan cost to a client, which is unlikely. Leave this unchecked. Client. Optional. Leave this blank as the loan is not directly related to a specific client. Save the expense. Once you've filled in all the necessary details, click the Save button. What we've done. By recording this expense under a liability category, you've effectively increased your loan payable balance, reflecting the money your business now owes. Phase 2. Recording loan repayments, principal and interest. Each time you make a loan payment, you'll need to record it in FreshBooks. This will typically involve both the principal repayment, reducing your outstanding loan balance, and the interest expense. Here's how to handle each part. Navigate to the Expenses section. Again, go to the Expenses tab. Create a new expense. Click plus New Expense. Record the interest expense. Vendor. Enter the name of the lender. Date. Enter the date of the loan payment. Category. Select an appropriate interest expense category. If you don't have one, create it by clicking plus New Category and naming it accordingly. Ensure the type is set to Expense. Amount. Enter the amount of interest paid for this installment. This information will usually be detailed in your loan statement. Tax. If applicable, interest expense is generally not taxable. Description. Recommended. Add a description like interest portion of loan payment for month, year, or loan payment #XYZ interest. Payment details. Optional but helpful. You can add details about how the payment was made, e.g., bank transfer, check #. Save the interest expense. Click Save. Record the principal repayment. To reduce your loan payable balance, we'll record another expense linked to the original loan. Vendor. Enter the name of the lender. Date. Enter the date of the loan payment, same as the interest payment. Category. Select the loan payable liability category you created earlier. Amount. Enter the principal portion of your loan payment. Tax. Leave as no tax. Description. Recommended add a description like principal portion of loan payment for month, year, or loan payment #XYZ principal. Payment details, optional but helpful, include payment method details. Save the principal repayment. Click Save. Important note, for each loan payment you will essentially be recording two expenses. One for the interest expense, under an expense category, and one for the principal repayment, reducing the liability under your loan payable category. Keeping track and reconciling. Regularly review your loan payable liability account in your FreshBooks reports, like the balance sheet, to ensure the balance reflects the outstanding amount of your loan. You should also compare your FreshBooks records with your loan statements from the lender to ensure everything matches up. This process is called reconciliation and is vital for maintaining accurate financial records. Handling loan fees and other costs. If you incurred any fees associated with obtaining the loan, e.g., origination fees, you would typically record these as separate expenses under an appropriate fees or finance charges expense category when they were incurred.